Gold's been blasting through all-time highs, and every time it does, one question keeps on popping up. Is the US government going to revalue its gold? And what impact would that even have? So today, we're going to look at what revaluation actually means, why the US government may or may not do it, and whether that would be bullish or bearish for gold and the broader markets. My name is Louis, and you're watching the Coin Bureau. First up though, I'm not a financial advisor, and nothing in this video should be considered financial advice. This is educational content meant to inform you about what's going on with America's gold. That sounds good? Then hit that like button and let's get into it. So, with gold prices soaring ever higher, there's more and more chatter about the US revaluing its gold reserves. But just how much gold does the US government actually hold? Well, officially, the US government says it has just over 261 million troy ounces of gold. That's a whopping 8,133 metric tons. Those figures come from the Treasury's own dataset that claims to track the official hoard by the ounce. Most of this gold sits at the US Bullion Depository at Fort Knox in Kentucky, with large chunks also at West Point and Denver. The Treasury also notes coins and bullion held or displayed at certain Federal Reserve locations. In other words, a majority of the gold is held in big, secretive vaults, and most of them are run by the US Mint. Now, we emphasize the word secretive here because there are doubts about these official numbers. Some are skeptical that the US actually has all of this gold, largely due to the absence of a modern, comprehensive bar-by-bar audit. While there have been multi-year audit programs in recent decades that sampled and sealed vault compartments, there hasn't been a fresh end-to-end re-verification of every bar. A few glimpses have been publicized in the past, such as then Treasury Secretary Steven Mnuchin's tour of Fort Knox back in 2017, but that certainly didn't settle people's concerns. And now, even President Trump himself has openly questioned whether Fort Knox is still full, and talked about going to check if somebody stole the gold. To be fair, there are some official checks. In 2023, the Treasury's Office of Inspector General issued a financial statement audit of the schedules of U.S. gold reserves held by Federal Reserve banks. But a financial statement audit is not a bar-by-bar inspection. So skeptics remain, and you can't really blame them. Yes, there's some oversight, but the gap between that and a transparent, comprehensive audit is exactly why suspicion grows. But whatever your opinion on that, here's the part that really confuses people and sets the stage for revaluation talk. On paper, the US doesn't hold its gold at market prices. It uses a fixed statutory price set by law, $42.22 per troy ounce. That number is a relic from the 1970s, and it hasn't moved since. Because the book price is frozen in time, the gold shows up in the financial system as a tiny fraction of its real-world value. This means that the Treasury's gold holdings are officially valued at around $11 billion. But again, that reflects the statutory price, not today's market spot price. It stayed low for decades, even while gold makes new highs. If we adjust for actual gold prices, the US is actually holding around $1 trillion worth of gold. The gap between $11 billion on the books and $1 trillion at market is why revaluation keeps coming up whenever gold runs. So, is the gold really there? Officially, yes. Are there skeptics? Also yes. But even if you're suspicious, the crucial, undisputed fact is this. The US values its gold at $42.22 per ounce, a price that bears no resemblance to real-world spot. And it means the government's own balance sheets severely understate the value of the bullion it already owns, hence the calls for it to be revalued. But what does revaluing the gold actually mean, and how would it work? When people say revalue the gold, they're talking about changing the statutory price Washington uses to value its gold, which of course is $42.22 per ounce. People want to revalue it because that price, as we mentioned, was set back in the 1970s. Now, just to be clear, all US monetary gold is owned by the Treasury, not the Fed. The Treasury monetizes that gold by issuing gold certificates to the Fed, and those certificates are valued at $42.22. But if Congress changes that statutory price, then the Treasury could swap out the old certificates for new ones at the higher price, and the Fed would credit the Treasury's account accordingly. It's an accounting change that can create a one-time windfall. It doesn't conjure new metal out of thin air, but it would boost the government's financial position, and possibly to an extreme degree depending on the markup. Given the current dynamic, a big gold revaluation would be a much-needed balance sheet relief in the face of swelling government deficits and interest costs. The typical ways of addressing those issues involves either cutting government spending or raising taxes, and neither are easy to actually implement in practice. So, in a world of trillion-dollar shortfalls and rising debt service burdens, that accounting uplift is very tempting. You basically print $1 trillion of assets to offset the liabilities, without technically printing anything at all. This may sound like an extreme measure, but it has actually happened before. Perhaps most notably with the Gold Reserve Act of 1934. That's when Washington centralized the nation's monetary gold and, after raising the official price to $35 per ounce, realized a bookkeeping quote-unquote profit. So, a revaluation of gold isn't just some fringe idea. It's happened before, and it could happen again. But how soon could this happen again in the modern day? Well, first, it would take congressional action, so this isn't something the Fed or Treasury can do by themselves. Second, the political mood would have to line up with the movement. While news outlets are talking more and more about the idea, it doesn't yet appear to be under serious consideration inside the White House. That alone offers some insight here. This is a powerful lever that policymakers might reach for only in serious circumstances. A gold revaluation is a big decision, and especially so given the backdrop of gold's recent rally and questions looming over the US dollar's status as the world's reserve currency. Whether it happens depends on three things lining up at once: a clear need for funds, a Congress willing to change the statute, and an administration comfortable with the optics and the knock-on effects for markets. Now, what could those knock-on effects of a gold revaluation look like? Well, there's reason to believe that it would actually be bullish for many asset classes. Let's break it down a bit. If Washington raised the book price of its gold and then monetized it by issuing additional gold certificates to the Fed, the Treasury General Account, or TGA, would get a huge boost. If the Treasury spends that balance, it would be a liquidity injection into the banking system. Now, let's picture that spending impulse in the broader market. A fatter Treasury balance that gets used on government programs or other government investments can function a lot like a mini stimulus. If that comes while the Fed is already easing or money market rates are drifting down, the combination can lift equities, tighten credit spreads, and push commodity baskets higher alongside gold. That's a classic liquidity wave that can show up across many asset classes at once. But again, as a recent Fed note on reserve revaluations highlights, a gold revaluation is a one-off source of funds, so it's not a regime shift that lasts weeks, months, or years. It's a short-term impulse. But what about the gold price itself? The statutory number on a government ledger doesn't force gold's market price to move. The market reacts to supply and demand, market sellers and market buyers. But if a revaluation comes with a clear policy stance that signals the government is becoming more of a gold bug, that could create a perceived floor or at least a strong narrative tailwind. There's also the global angle. Central banks have been steady net buyers of gold, and they've been ramping up those buys recently, diversifying their reserves over the last few years. If the US revalues its gold, that could validate what official buyers have already been doing, indirectly reinforcing the hard asset trade. That would likely also spill over into miners and other related equities. But as far as gold is concerned, the direct impact is just bookkeeping. The big market story is found in the follow-through and the second-order effects. If the proceeds of a treasury markup gets used, that's fresh cash into the system, and it could lift markets in a big way. But what happens if things don't go smoothly? Well, for starters, there's some real headline risk when it comes to the underlying signal to markets. If investors read a gold revaluation as Washington reaching for a financial shortcut, that can shake confidence in the markets rather than boost them. Recent reporting has indicated that the idea is not under serious White House consideration, precisely because it's so controversial and easy to misread. Governments survive based on their credibility. So any indication that the White House is reaching for quote-unquote accounting tricks can be enough to put markets on edge. Think US bond volatility and the like. Then we have issues for the monetary plumbing that's behind things. Market strategist Seth Wrightson warned that a gold revolution would be a messy outcome for the Federal Reserve's policy mix. Why? Because it could inject liquidity at the same time the Fed is trying to manage reserves and its quantitative tightening goals via balance sheet runoff. Again, that kind of tug-of-war and mixed signal invites market volatility. Money market conditions loosen just as policymakers are trying to keep them tight, and traders start second-guessing the path for interest rates. So, marking gold to market might unlock a big liquidity injection, but it would also complicate the Fed's balance sheet and even raise inflation fears. Another risk is the one-and-done nature of cash injection from a gold revaluation. That can help in a pinch, but it doesn't solve long-term deficits. If markets conclude it's a temporary patch rather than a plan, any initial pop in risk assets can fade into harder questions about the fiscal outlook. And once again, those questions tend to land in the bond market. That's because bonds care most about two things: inflation risks and fiscal discipline. If a revaluation is paired with new spending, investors can treat it like a stimulus. Even if the effect is small, the signal can matter. In recent months, we've seen just how quickly long-dated bond yields jump when investors worry about bigger deficits or looser policy. And by extension, higher long yields tighten financial conditions, which is bearish for equities and credit. If we take a slightly different angle here, some investors, especially reserve managers, could read a revaluation as the US elevating gold's monetary role. That would be especially important because central banks have already been buying at a historic pace, repeatedly crossing 1,000 tons a year since 2022. Layer on the desire to hold assets that can't be sanctioned or frozen, and you have a ready-made narrative for shifting a slice of reserves out of bonds and into bullion. As we've outlined, bond markets have been sensitive recently. If we combine that sensitivity with a fresh policy that seems to favor gold status, you raise the odds of fractured bidding and jumpier bond markets. Now, a revaluation doesn't restore the gold standard or anything like that, but it does further spotlight gold as a balance sheet pillar, even more so since we've seen huge gold demand in the market. This is even more significant in a world already debating the costs of concentrated dollar risk. So, put it simply, the main reason why the government hasn't pursued a gold revaluation is primarily due to those potentially destabilizing effects outweighing the potential upside. At least that's how policymakers have viewed it in the past. President Trump is known to be unconventional, though, to say the least. So let's not rule anything out here. Now, if the gold revaluation is not to be, what alternatives does the government have to raise more cash? Well, there are cleaner, well-trodden ways to monetize federal assets without opening the Fort Knox debate. Let's start with the one resource that's truly finite: land. The federal government owns roughly 640 million acres. That's about 28% of U.S. land. Now, we're not suggesting the government is going to sell Yosemite, but it means the government can lease use rights or dispose of underused areas with a clear process and congressional oversight. The Congressional Research Service has been consistent on this. America's public lands are vast, and policy gives lawmakers multiple ways to monetize them carefully. And when we say underused, that's not a hypothetical when it comes to the government's real property, which is government-owned land and the stuff that's built on it. The Government Accountability Office has flagged federal real property management as a long-running problem. Improving how agencies identify, maintain, lease, or sell real property could have a significant impact on the government's finances. It's a way to save money and raise it too, without stirring monetary system debates. Depending on the market cycle, oil and gas lease sales bring in revenue as well. Auctions in the Gulf of Mexico continue to attract bids, so administrations can dial those programs up or down within their policy goals. And there's also more exotic forms of assets, like the airwaves. Yes, in the US, radio spectrum is public property owned by the government, and the FCC leases chunks of it out via auctions. One such sale back in 2021 bought in $81 billion in gross bids that ultimately flowed to the Treasury. When demand exists, airwave auctions are a serious source of revenue. New revenue sources are taking shape too. Earlier this year, even the idea of a U.S. sovereign wealth fund was proposed, before morphing into what's now described as a national and economic security fund. This has become a structure tied to proceeds from trade agreements and strategic investments, as Trump implements some unorthodox trade negotiations on the global stage. In that same vein, Commerce Secretary Howard Lutnick has been vocally pushing for ways to channel non-tax revenues and partner money into the economy. You can agree or disagree with the approach. The main point here is that there's an active conversation in Washington about mobilizing assets other than gold to raise funds. And the common thread in these alternatives is that they rely on existing authorities and familiar processes. None of these steps require changing the legal price of gold, and none signal a shift back towards a gold-anchored monetary system. Does this make them painless? Well, no, of course not. Every option has trade-offs. Almost all of these possible monetization avenues largely depend on market demand, in contrast to a gold revaluation, which is just an accounting adjustment. But from a policy optics standpoint, these levers are easier to defend than a gold revaluation that markets might read as reckless. So, the US government that needs money has lots of ways to go get it. Some fast, some slow, some flashy, some boring. A gold revaluation is just one on a very crowded menu. But what do you think? Should the US government revalue its gold? If you think the gold reserves should at least be audited for starters, let us know in the comments down below. And if you want to find out what the BRICS countries are up to while this discussion rages on, well, you can watch our video on that right over here. As always, thank you all for watching, and I'll see you again very soon. This is Lewis, over and out.